Sri Guru Kripa's Institute of Management. Knowledge is light.
Greetings. In this module, we are going to see the procedure for preparation of funds flow statement and the cash flow statement. These are two very important tools in financial analysis and in evaluating where from money has been obtained during a particular period and how that money has been used in that particular period. As you all know, two very basic aspects of financial management is getting money and using money. These are called procurement of funds and utilization of funds respectively. So we need to analyze at the end of the period where from these funds have been procured and how these have been effectively used, and which provides further inputs on how to plan our activities for a subsequent period. Now we shall see what is the procedure for preparation of the funds flow statement. We have to get some basic information in preparing the funds flow statement. The basic information will comprise financial statements, balance sheets at the end of two different periods, that is the opening and the closing dates of a particular period, and also certain additional information relating to some transactions during that period. Now, what are all the steps involved in the preparation of the funds flow statement? Four broad steps are involved. The first step is to prepare a statement of working capital changes, and this is done by analyzing all the current assets and the current liability items. So consider the balance sheet, identify what are all the current asset items and the current liability items, and thereafter find out whether there is an increase or decrease during that period item wise, and find out what is the net increase or decrease in the working capital. The net increase or decrease represents a application of fund or a source of fund, as the case may be. Suppose there is a net increase in working capital, it means during that period further money has been invested, blocked in the working capital, that constitutes an application of fund. The reverse is the case in terms of decrease in working capital. Then second step, after analyzing current assets and current liabilities, we look at the other items in the balance sheet, non-current assets and non-current liabilities. We identify each item of non-current assets and non-current liabilities from the balance sheet to pick up two types of information. What are these two types of information that we try to pick up? One is source and application of fund. This is one type of item. The other type of item is non-cash or non-operating items. Let us look at the first aspect, the source and application of funds. A few examples I can give you in this connection. One is fixed assets. Suppose land account is specified in the balance sheet. The opening balance says 5 lakhs and the closing balance says 12 lakhs. It means during that period 7 lakhs worth land has been purchased. I am giving you this example without considering depreciation. Suppose depreciation related information is given for certain other assets like plant and machinery, furniture, etc. We can prepare the respective ledger account, identify the opening and the closing balances, and find out what is the net amount of asset purchase during that period. An asset purchase represents application of fund. On the other hand, an asset sold represents a source of fund. This is the source and application with respect to fixed assets. Consider a few non-current liability items. For example, debentures. The opening and the closing balances are stated at 10 lakhs and 4 lakhs. This represents 6 lakhs of debenture redemption during that period. Some additional information may be available as to debenture redeemed at premium, etc. Those information should also be considered for calculating what is the amount of outflow. Suppose share capital, the opening and the closing balances are 5 lakhs and 10 lakhs. Extra 5 lakhs of capital has been brought in during that period by issue of shares. That is the additional source of fund. So this is one of the items that we pick up from the balance sheet, non-current assets and non-current liability with respect to sources and application of fund. The other type of item that we pick up is non-cash and non-operating items. There are three sub-segmentations involved in this non-cash, non-operating item. An item could be a non-cash but operating item. For example, depreciation, non-cash but operating. This is one type. Second type, an item could be cash but non-operating. What is cash or non-operating? Again, an example could be premium on redemption of preference share capital, premium on redemption of debentures, etc. A payment has been made during the period in cash, but it is a non-operating item. The third type of item is both non-cash as well as non-operating. Say preliminary expenses written off during the period, both are non-cash as well as non-operating items. So we try to identify these three types of items with respect to the second category. So the third step after doing this is to take the profit for the period and find out what is the funds from operations during the period. So what is this funds from operations? What is this concept? The funds from operations represent the gross surplus generated from the activities during a period. How to calculate the funds from operations? It is a very simple calculation as to reverse process in the P&L statement. What is this reverse process? We take the P&L statement top-down form in this manner. Sales minus variable cost is contribution. Contribution minus fixed cost is EBIT, earnings before interest and tax. Thereafter, we subtract interest, that gives you earnings before tax. We subtract taxation, that gives you earnings after tax. We subtract preference dividend and equity dividend, that gives us the retained earnings. And a portion of this is sent to the reserves account, transfer to reserves. The balance is retained in the P&L account. This is the top-down structure of the P&L statement. Now, when we try to calculate the funds from operations, we try to look at it in the reverse direction. Profit for the period after all adjustments and transfers, after doing all the deductions that we have seen in the P&L statement, that is the starting point of our calculation. We roll back in the same order in which we have subtracted, but in the opposite direction. Point number one, any transfer to reserve, that is added back. Any dividends proposed during the period, that is added back. Then taxation during the period, added back. Then any non-cash, non-operating items, these are added back. So if you add back all these items, the surplus is what we call as the funds from operations. This is the gross surplus generated, and this is available for providing depreciation, for providing taxation, for providing for dividend, and also balance to be retained in the business. So this is the third step in the preparation of the funds flow statement. The fourth and final step is to consolidate all the previous calculations and present it in a form of a funds flow statement. So just to recap, the first step was to find out what is the increase or decrease in net working capital by analyzing current assets and current liabilities. We prepare a statement of changes in working capital. Second step was to analyze non-current assets and non-current liabilities. We find out two types of items. One is source and application of fund. The other one is non-cash and non-operating items. The third one is to analyze the profit for the period and compute funds from operations. Now, how do we proceed to consolidate all this into a funds flow statement? That is the last step. A funds flow statement is a T-shaped presentation. On the left-hand side of the statement, we have the sources of fund. On the right-hand side of the statement, we have the application of fund. What are all the major sources of fund? The basic source of fund is the funds from operations during the period. Any company which makes a profit generates this surplus during this period, and this surplus is available for the purpose of various applications. So that is the major source of fund. After that, we also have other sources, both from the asset side of the balance sheet as well as from the liability side of the balance sheet, both ways non-current items. Say sale of fixed assets and long-term investments. These constitute balance sheet asset side item sources. Similarly, issue of shares and also issue of preference shares or equity shares or debentures, etc. These constitute from the liability side of the balance sheet. These constitute source of fund. So these are all the sources of fund that a company can identify. Correspondingly, we have the application of fund on the right hand side of the funds flow statement. The net increase in the working capital constitutes an application of fund. We also have purchase of fixed assets, purchase of long-term investments. Then we have redemption of capital, redemption of debentures, redemption of preference shares, and buyback of equity shares, if any. Tax payment and dividend payment also constitute a major item of application of funds. If by chance a company has made a huge loss and there is a funds lost in operations, that will constitute a decrease or that will constitute a application of fund. So by comparing 2 years financial statements and using the additional information, we prepare the funds flow statement in this manner. This provides an idea of where from the funds have been obtained and where the funds have been used during a particular period. This funds flow statement is what is considered on working capital basis. Now, if we were to prepare this purely on cash basis, we call that statement as a cash flow statement. For this cash flow statement, we have Accounting Standard 3 issued by the Institute of Chartered Accountants of India, which provides the manner in which the cash flow statement is to be prepared and presented in respect to historical information. Now, the cash flow statement is basically a reconciliation between the closing balances of cash and cash equivalents and the opening balances of cash and cash equivalents for that particular period. Cash equivalents or cash and cash equivalents comprise cash in hand, cash at bank, short-term investments having maturity period, very low maturity period. So considering this, first identify what are all the cash and the cash equivalents, what is the closing balance thereof, and what is the opening balance thereof. This represents the net increase or decrease in the cash and the cash equivalents during the period. Now, the accounting standard recognizes three kinds of activities which have contributed to this cash flow. One is called operating activities, second, investing activities, third, financing activities. I would like you to visualize a balance sheet and identify the segments for the various activities which are required to be shown in the cash flow statement. I repeat, operating activities, investing activities, and financing activities. Now, I would like you to consider the information in the reverse order in which I have stated. We start with the financing activities. Financing activities, what items will be comprised here? Very simple, they comprise only long-term non-current liability items in the balance sheet. I repeat, financing activities comprise long-term non-current liability items, which means we are referring to equity capital, preference capital, and debt. Two kinds of cash movements are considered under these three headings. What are the two kinds of cash movements? Capital account movement and revenue account movement. Capital account movement represents any issue or redemption of the capital, equity, preference, and debt. Revenue account movement comprises only payment, namely dividend payment and interest payment. So, financing activities comprise all movements relating to equity capital, preference capital, and debt, namely capital movement and revenue movement. Now we come to the next item, investing activities. What items are covered under investing activities? Very simple. Asset side long-term items are considered, namely fixed assets and long-term investments. Again, we have two kinds of movements, capital account movement as well as revenue account movement. Capital account movement, we consider purchase of fixed assets or sale of fixed assets or investments. Revenue account movement, if there are any non-operating investments, income from these non-operating investments together with the tax effect thereon, if any, will be considered under this category. Now, whatever balance is available in the balance sheet, they will be shown under the heading operating activities. There are two ways in which information can be presented in the operating activities segment. One is called direct method. The other one is called indirect method. Direct method requires you to identify the various inflows and outflows of cash under separate headings. For example, what is the cash sales during the period and collection from customers during the period. This is a major inflow revenue item. Another revenue item, cash flows by way of activities. If there are any royalties or other operating incomes which are received, what is the amount of such received during the period. So sales and other revenues, collections are considered. Payments to creditors, payments to employees for their services, and the payment for other expenses for various services procured during the period, all these are considered under the heading operating activities. So the net cash flow arising out of these five activities is called as the operating cash flow. Now, operating cash flow, I consider these five items again for your reference. The cash sales and collection from customers, other operating incomes received during the period, cash paid to creditors for materials obtained, then cash paid to employees for services obtained from them, and also cash paid towards other expenses. The net total of all these represent the operating cash flow, and this is subject to two more reductions. If there are any extraordinary items, they have to be shown separately on the face of the cash flow statement. Tax payment is also shown separately on the face of the cash flow statement. This presentation is called as the direct method. As opposed to this, we also have the indirect method of presenting information under operating activities. Indirect method of presentation is similar to what we have structured in funds flow statement towards the concept funds from operations. We take the profit for the year after all adjustments and transfers, add back in this order the transfer to reserves, proposed dividend during the period, provision for taxation, and all non-cash, non-operating items. The net total of all these represent operating cash flow before considering working capital changes. After this, we consider the adjustments in respect of working capital changes excluding cash and the cash equivalents. So we have increase in stock or decrease in stock as the case may be. Similarly in debtors, creditors, etc., the corresponding cash impact is considered. To give you an example, if there is an increase in debtors from 5 lakhs to 7 lakhs, it means to that extent money has not been collected. This represents an outflow of cash. Similarly, if there is a decrease in creditors, 7 lakh to 3 lakh, 4 lakh rupees excess money has flown out during the period to the extent of a reduction in creditors that again constitutes a cash outflow. So like this, we identify what are all the working capital changes and add or subtract as the case may be to obtain the operating cash flow before taxes and extraordinary items. Thereafter, we show a separate deduction in respect of any extraordinary items, earthquake or disaster or tsunami related settlements or any such insurance compensation, and tax payment during the year that is also shown as a separate item. So this is the broad procedure for preparing the cash flow statement. When it comes to presentation of information, it would be the reverse of what we have understood for the purpose of analyzing the balance sheet for cash flow purposes. We start with the operating activities, item number A. Item number B will be the investing activities. Item number C will be the financing activities. The net total of A, B and C, we call it as the net increase or decrease in the cash flow during the period, that is item number D. Item number E represents the opening balances of cash and cash equivalents. D plus E represents the closing balance of cash and cash equivalents, the closing balance at the end of that period. This is the way in which a cash flow statement is structured. Now, what is the basic input again required for the cash flow statement? That is similar to a funds flow statement. 2 dates balance sheets, that is the opening and the closing date, certain additional information relating to depreciation, how assets have been purchased or how the debentures have been redeemed or fresh equity capital has been raised, etc. With this additional information, we should be able to present the cash flow statement also. So these are all the broad guidelines for preparation of the cash flow statement and for preparation of the funds flow statement. And by analyzing a few illustrations as to how it has been prepared, and also by reasonably practicing or by ensuring proper practice of a reasonable number of illustrations, you should be able to have a good control over the preparation procedures for the cash flow statement and the fund flow statement.